Hello, everybody. Happy Halloween. We have an amazing lender today. I'm super excited to introduce him, and he's got some really, really good points about the mortgage market. So let's welcome Dan Lever.
Hello, hello, hello. Good to see you, Roxanne. Nice to be a part of this. And I'm wearing my traditional Viking hat for the spirit of Halloween. I am barely keeping my headset on, but just wanted to wear it for the intro. I'm going to have to switch over to my hat to finish it up, though.
Good. We have enjoyed those horns. So now you can take them off and become the mortgage lender.
Sounds good. Sounds good.
All right, excellent. Look at that. Okay, very good. Well, that's it. You're a winner, a Viking winner today. All right. So I'm going to keep mine for the duration of our presentation and our talk. So yeah, tell us a little bit about who you are, where you work, and what you do.
Absolutely. So I'm Dan. I've been in the industry now. I've got an after college, so figured out that this is what I want to do, and I've been doing it for a very long time. I didn't just start off as an LO. I worked my way through the chains, starting from just being your average processing assistant, then going from a LOA helping close over $100 million before taking on this role. So been enjoying it now fully independent and have been independent for quite some time, and now I'm just looking forward to sharing what I know, helping families and helping agents, and making a win-win for everybody. I'm now at Cornerstone First Mortgage, which is a correspondent lender, which means we can work with multiple different banks, and instead of giving it to the bank to process, we process it in-house and then sell it to them. So it's a unique situation to be in, but I find that you get access to better interest rates and more loan programs, and we have more control over it instead of having to um, see where it goes with the other bank and just play phone tag with them.
Exactly, exactly. So that's really good to actually know. And you at first you came up with LO. So if you can tell our audience what is an LO and what's the difference between your title now versus being an LO.
Yeah, so my title of being an LO is a loan officer for those who don't know that. So a loan officer is someone who just takes applications, approves you, and maybe has a 9 to 5. Where if you're in our position, we're in the same boat as you. We're commission only, so we're more motivated to get the deal done. There's no hourly, no clocking out from 9 to 5. If we have a meeting at 7:30 p.m. or 8 p.m., we are designed to make those, and we also are designed to work weekends as well, and have that availability to cater towards you in case something comes up, you need something worked on, or God forbid there's a fire. I want to be, we're your 911 to save a transaction that might have fell through. So that's how we're designed over here.
You're talking about mortgage fire, not actual fire, correct?
Correct. Yeah, don't send me to an actual fire. I, I won't do so good there. Yeah, mortgage fire. So if transaction fell through on your listing, or if the that mysterious loan officer you're working with that you haven't worked before, that your client introduced you to, if that fell through, we're the ones you call to fix it and get it closed.
Thank you for that. Thank you for that. And there are so many horror stories that we professionals know about and we have experienced. So tell us a little bit about those horror stories, or I can talk about those horror stories, and then talk about how you are different, and the client is not going to experience those horror stories if they're working with you.
Yeah, absolutely. I can tell you about a recent save I did. So I work all over California as well. We're also licensed here at this company in 48 states. So we just don't work in Alaska or New York yet. We're working on those licenses. But I was working for a client. I got called by a real estate agent that I work with. They were working with another broker, and they had a GSFA loan, which is down payment assistance. The loan officer on the other side went past the closing date and was getting notices to perform. The real estate agent called me, said, "Hey, I need this closed because were at the finish line. We're already past the finish line and it's not closed yet." I went in, and these are like Cal Halfa programs. So these take like 30 days. So for us, I was able to go in, get everything that I need from the client. We were able to close it in 2 weeks.
Wow.
So that's the dedication that we have when it comes to saving you from those horror stories. Or if you are going through a horror story, we want to come in and just make sure that we get it closed and figure out what the issue was and how we can come up with a solution. So we're really big on solution selling instead of just, oh, you're qualified, here's your payment, here you go shopping. It's more, this is going to work from day one.
And
And
and also let's talk about the client's deposit, because I think that's a really huge one that your average buyers don't understand. Can you talk about the deposit and how your role is basically crucial in saving that deposit?
yeah, the earnest money deposit.
Correct.
So when we're going through escrow together, there's two contingencies. There's the appraisal and the loan contingency, and then there's also the inspection, but I'm mostly focused on the first two since that's what I have control over.
Yes.
So if we go through and we waive appraisal and we waive loan contingency and then it doesn't work out, you put that EMD at risk. And so that's why it's really important for clients to understand who they're working with and the confidence that they have in who they're working with. And same with the real estate agent. They want to know that if we're removing these, it's because it's going to work. It's not going to put their deposit at risk. And some of these deposits are as little as $3,000, maybe $4,000. Others are $12,000. And so
Or
if
higher.
or higher. So you don't want to put that at risk. And so that's why when you're working with someone like myself, you want to make sure that they're going to be able to take you to the finish line and give you a 5-star experience and give your client a 5-star experience as well.
Right. And don't put you through the stress of, oh my God, now I'm about to lose my deposit because my loan officer did not, made a promise, did not keep it, or made a promise, and then afterwards reneged on the promise, or the underwriter came up with 11th hour conditions that
Yeah,
expected, and now we have a problem.
exactly. Yeah, especially, and a lot of these issues I've heard and I've also seen happen to other people. They always happen like that last week or a few days before you're supposed to close too. So
Yeah.
that's the worst thing. That's why you should always have communication, communication, communication. You should know what the issues are prior to removing contingency.
Absolutely. So now let's get to interest rates and that your crystal ball of seeing what's coming in the pike and in the future. So
Absolutely. Am I able to share my screen with you?
yes, absolutely.
Awesome. I'm going to show you guys. So when I show you guys interest rates today, what I'm going to do is kind of show you how I would explain it to a client. And the way I explain it to clients, I think is going to translate really easy to you guys because it's important for you to know if interest rates are changing higher or getting lower. It's going to change the confidence that you are going to experience with your buyer or your seller. And on my side, I'm more of a dentist shop, right? I just go in, I do my job, I make sure I do a good job, and then send them on their way. When they're with you, it's an emotional roller coaster. These clients are happy one week, they're sad the other week, and it's more out of my side, and I'm just on the sidelines hoping everything's going good. So for you guys, this will be nice to know if interest rates are going higher and lower, and I'm having to communicate this with them. So this should help you get kind of some insight on how the market works and how it impacts you. So I'm going
Ah,
to share my screen. Oh, go ahead.
go ahead. Go ahead.
Oh, okay. Let me see. How do I screen share? All right.
There
Okay.
should
And
be
then
a
we're going
button
to
that says
do this one. Boom. There we go. Good thing I'm a millennial. I can do this.
there we
All right.
go.
So this is what I look at every day. I read in the morning 3 reports that come out every morning. Rates open up. I'm looking at them. This is what's been going on the um, last 3 months right here. So this is our 3-month graph. So as you can see right here, this getting lower is not good. When you're looking at these, you kind of want to think of them as a stock, right? When the stock is going up, it's a good thing. If the stock is going down, it's a bad thing. Same thing with interest rates. And so when we're looking at this, we're looking at what is this how is this going to impact your clients? How is this going to impact people looking to apply for a home? And how is this going to impact your conversion? So when we're talking to clients as well, we're showing them that this is what the life cycle of interest rates looks like. Right here, we were doing really good, and then this would have been a really great time to lock people in. Sometimes when we're under contract, let's say we get under contract on August 30th. Sometimes it might not be the best time to lock. We want to see if going up here is a better time to lock. So we might delay locking the loan for maybe a week or two to see if we can get them into a better position. Right now, starting from about October 2nd to present day, this whole month has not been a great month for interest rates. We had the interest rate lower in September, and now we're at the end of October, and interest rates are increased and not in a good position. Now, if a client is going through and they're seeing that interest rates are now over 7% again on the news, how do you address that? Well, if we go to another time where interest rates were higher, let's pull it back to 6 months, you can see that if every month is volatile. And sometimes we have these swings that go up and they keep swinging and going up, and then other times we have swings where they go down. So what I typically recommend is, and this isn't good, this is just today's interest rate. It's not the interest rate you're going to have next week or the following week. And so what we do is we do a thing called floating. And so our job is to make sure that you get the best interest rate possible. And this is how we track it: is we're going to read reports coming out every day. We have a federal interest rate increase happening in November. So when we're talking to these clients, we're showing them that this is where it's at today. But when the Fed does another 25 basis point drop in interest rates, we're thinking that we're going to get to about right here. So it makes sense not to lock today and to wait until then to help them, go from, let's say, a 7% to a 6.75 or a 6.5%, just through waiting. And so that's how this can impact your listings too. When you see interest rates increase or go down like this on the chart, that means that buyers are going to be a little bit scared from entering the market or applying or shopping, because this happens. So it's really important to track this and know where they're at week to week, so that way you know what's going to happen with your clients as you're shopping and giving them the experience, and with your sellers on your confidence on putting on the market and how they're going to get an offer and how many offers might come in too.
So talk to us a little bit, Dan, about locking the rate. What does that mean? How does that affect a buyer? How does that affect the transaction? Because I know we're dealing with that, but I'm not sure if the average buyer knows what that means and how that affects them.
Yeah, so locking in an interest rate is like locking in a commitment, right? You're putting a ring on your rate. Is the funny way to describe it. You're getting committed to this payment. And when we're looking at locking in an interest rate, let me just pull this back to the 3-month view. What we're doing is, let's say we lock in right here. You can see these little locks on here. This is a lock alert. And so what we do is we'll get these to know, to give me advice on, hey, maybe we should lock today. Maybe we shouldn't lock today. But when you're locking into an interest rate, you're choosing that payment for the next 30 years. And so you have to make sure that whoever you're working with is comfortable with that payment, and you need to know what they're comfortable with ahead of time. It's not about the purchase price, it's about the payment. If they're not committed to the payment, then they're not going to be committed to the purchase. That's just how I've seen it work. So when you're locking in an interest rate, you want to make sure you talk about the payment ahead of time. You want to know what they're comfortable with and what their max is. Sometimes if the market takes a turn like this, sometimes their comfortable payment now becomes their max payment because interest rates got higher. So you have to know how to work with that. And so when you're going through the beginning process and then under contract with the locked process, locking them into that payment, you want to make sure that you build in enough room so that way they know that payments can change, interest rates can change, but they're still committed because you set expectations with them. And setting expectations is the most important part when it comes to locking them into a rate, because they already know where the payment was going to be ahead of time. You let them know that there's volatility, and they're still committed to that payment and that property that you showed them.
A lot of the times, talk to us about the length of the time that you can lock the rate. because sometimes you have complications in the process. Sometimes you have a tenant that needs to leave the property before the transaction closes. So, how long can you lock the rate? What happens if the time passes? What are the consequences? How do you deal with it?
Yeah, so there's different locking periods. So there's 15, 30, 45, 60, and then there's even lock before you shop, where if someone's really skittish on this market, they can lock ahead of time and then start shopping.
Mhm.
But the longer the period that you lock, the less risk you're taking on. And so typically how interest rates work is they'll give you a higher interest rate the bigger the period that you lock for. So
Mhm.
typically to get someone the best interest rate, it would be 15-day lock, right? But most escrows don't work out that way. Most escrows aren't 15 days. Most people want to do 30 days, 21 days. So what we typically do is a 30-day lock.
Oh,
And if we go past the period on a 30-day lock, what we have to do is an extension. And so extensions means you are going to choose, we're going to extend it 7 days, 3 days, what have you. Let's just say a report came back or we're waiting on the seller for something and it's going to delay the closing. Then we would have to do an extension of 3 days, and that's a cost to the client. So
mm,
extensions are really bad for both real estate contracts and for mortgages because it's going to cost clients more money, because every day that goes by, that's an added cost if we extend it. So that's why it's important to do your job ahead of time, know when you can close, know your contingency removal periods with that specific client. So that way you're going through, put them on a 30-day close that thing in 21 days or 15 days or 13 days, what have you, but don't risk them going into a 15-day, because if it delays by 10 days, then that's 10 days more they have to pay for. And then you lose that benefit.
we just had a loan that we just had a property that had a second that the seller was not aware of, and
Mm,
when
mm.
we discovered that, and then had to research and find out who the second was, and get a hold of them and basically get them to release. We were past the 30-day lock period, and that became very complicated, uh,
Mhm.
because now you had to, and then it also becomes a question of who's going to pay for that. Is it the buyer? Is it the seller? And the complications that come with that. So let the next question I have for you is: you lock your interest rate. Let's say you lock your interest rate at 6.75, and then the market drops, and now you can get the rate at 6%. How do you how do you deal with that? How do you deal with that?
Got you. So yeah, so let's say we lock right here, right at the absolutely worst time to lock, and then the market goes back up this way, and then it's an absolutely better time to lock, right? So I tend to want to avoid those situations, Roxanne. But let's say I put myself into that situation, how would I handle that? Now we're seeing on the news it's like 5.99, right? And the client's like, well, I'm at 7.6 or 7.7, 6.75. What I would do is we have two things that we have access to here. We can, and it's complicated to describe, but we have commitments to a lock. So let's say I lock it in, boom, it's existing that I locked it. But there's investors at this company that will commit to that lock. So if they don't commit to that lock in time, I can remove my lock, put it to today's pricing, and then reserve it. And then that alleviates that situation. Now,
Mm-hmm.
let's say if an investor committed to that lock period, they committed to buying that lock. Now I'm stuck. Now what do I do? We have a process where we can do what's called a profile change. If the difference is large enough, they will allow us to go to a lower interest rate as well.
Huh. The investor allows that.
Yeah, if the difference is large enough, if the percentage of change is large enough, they'll allow us to go up a tier and get access to that lower pricing. So I have two scenarios of how to deal with that. So if I catch it early enough, I can remove the lock and then relock it into the better interest rate before the investor commits to it here.
Mm-hmm.
Where if I'm stuck and the investor's already committed, then we can change it up if the difference is enough.
That's very cool.
Hmm.
So you still provide the best case scenario for for your borrower.
Correct. Yeah. And if we're especially in a time where it's volatile like this, where I think next month we have more insight because we know the Fed is dropping the interest rate. I would delay locking. I wouldn't just lock them in right here and then watch the Fed lower the interest rates and then try to deal with that scenario. I would rather just not lock after we get into escrow and let the market do its thing and then choose a better time to lock in. Maybe we get to here and that's a good time. And then the difference from here to here is very small. Maybe it might be a 0.25% difference in interest rate.
Now, the other day I was actually listening to this report, and their take was uh, prior to the interest rate drop that we had, mortgage rates were coming down. Then the Fed dropped the rate, and then
Hmm.
mortgage rates started going up from there. And their interpretation was that that's because the Fed saw that the economy was still robust, and so they decided that on their next meeting they're not going to drop the interest rates. So that's the reason why the mortgage rates went up after the Fed rate came down.
Yeah, so if you want to see the how this works, so we have the 10-year U.S. Treasury bonds. These two are completely inverse. So if the Treasury bond starts becoming stronger, if more people have confidence in the Treasury bond than they do in mortgage-backed securities, and Treasury bonds increase, then you're going to see mortgage rates decrease, meaning become higher. So that's what we saw in this month is mortgage or not mortgage, but our treasury rates were increasing. And that's why this got lower because our market was robust. When the market becomes not so robust, then you'll see the change and mortgage backed securities tend to take the lead. With
Mm,
these rate decreases, we can see right here with the scheduled rate drop, we saw a big tick and I was able to lock people into some refinances, able to get them a lower payment, go from 7.25 to some clients got 5.625. Now that we're seeing this decline here, I still think the Fed is going to lower the interest rates by a quarter by 25 basis points just because it's scheduled to. So I'm confident that will happen here. Maybe if they don't do it in November, it might be because of political instability, just because when we go through an election, it creates volatility. So maybe it might get delayed to December, but I'm still confident there will be a interest rate decrease because it's putting a lot of pressure on people.
right, right. So talk to us about basis points. What do they mean?
What a basis point means? Yeah, so I can calculate it for you so that way it makes more sense. So a basis point is a percentage of a percent. So 1% is 100 basis points. So 1.00, just remove the point. So 2% is 200 basis points. And so if we're locking in a loan and it's at par, meaning no cost to the client, par means no cost. But if they want to get access to a lower interest rate, then it costs basis points. And so let's say the loan amount is $500,000 that we're giving them, and
Mhm.
they want to get a lower interest rate, and that interest rate costs 1% of the loan amount to get access to. Then what you do is multiply it by 1%, and that's $5,000.
Mhm.
So when we say this extension is going to cost 5 basis points per day, then that translates to being calculated back on the loan amount. Oops, that's a little too much. That's how much the extension would be per day because the extension, as an example, would be 5 bips or 5 basis points. So
Mm.
everything that we talk about being basis points is dependent upon how much loan amount we're giving the client, and then it's a calculation of percents on the client on the loan amount towards the client. Does
Very,
that
very.
make sense? Did I do a good job explaining that?
You did a great job
Okay.
explaining.
Okay,
Uh,
good.
can you talk to us about what we used to see a lot of? Now every once in a while we're seeing that, and that's the closing cost credit of 2-to-1 buy downs, and those types of products.
Yeah, so a 2-1 buy down, there's many of them. So it starts from a 1-0, which means a reduction for 1 year, and then it goes back to the regular reduction, and then it goes all the way up to a 3-2-1 buy down. So when we're looking at a 2-1 buy down, typically when we start seeing this tick get over here, and if this continues to go even higher, or even lower, making interest rates become higher, then it becomes harder for sellers to find buyers or to incentivize buyers to purchase their property. So, Roxanne, as a seasoned professional like yourself, you know that that's when you have to give more seller credits or entice people to purchase your seller's property. So, that's when we say, hey, do you have enough credits to do a 2-1 buy down? And what that will do is, let's say the interest rate that the person is stuck with is 7%. A 2-1 buy down would temporarily get them to 5% because it's subtracting by 2. So we go from 7, 6 to 5% for the first year, for the first 12 months of payments. And then the 1 makes it 6% for the next 12 payments. And then it brings it down to 0, back to 7%. So it's subtracting it by 2, and then it's subtracting it by 1 based on the percent for a whole 24-month period. 2% interest rate reduction, 1% interest rate reduction, and then back to their original interest rate.
And
So
then
sometimes oh, go ahead.
the hope is at that point you can refinance and bring your interest rate permanently down.
Correct. Yeah, that's the purpose of that. So it's good for if we're in a tough market. Well, this kind of is a little bit of a tough market, but if interest rates continue this trajectory where they just keep getting higher and higher and higher, then we might see more buy downs come out. Where if interest rates get lower, then sellers have access to more buyers. Buyers have access to lower interest rates, and so it creates an even playing field. So those are very situational. You see buy downs come out typically when interest rates are higher, if those properties are really expensive and they want to gain a wider audience.
Right, exactly. All right. Well, this is fascinating stuff. Of course, we all love it when we're in this environment. And and Dan, is there anything else that you want to share with our audience that we did not cover?
Absolutely. I have three things. I was going to show you guys this screen right here too, but we were having a good talk. This is something I showed at open houses. This is also how you get clients the best interest rate as well in the markets. This is called LLPA, or loan level pricing adjustments. This is an artificial charge, just to touch back on basis points like we were, Roxanne. The government artificially charges you on your interest rate depending on your down payment, your credit score, and what type of property you're buying. So this is something I show to people at open houses when they're asking me, like, how much should I put down on this property, or how do I get the best interest rate, or when people tell me what's your rate. This is kind of the chart that we look at when we're doing this. So let's say someone wants to buy a condo, right? Right here, these are all artificial charges against them, but you can see right here when they put 25% down, they get the lowest amount of charge.
Mhm.
So when I'm working with home buyers and showing them how they can get the cheapest interest rate and the best property, where somebody has a extremely higher rate than somebody else and they're both buying the same property, it's because their down payment might be different, the type of property that might be different, or their credit score might be different. They could be charged an additional 187 basis points just because their credit score is right here compared to somebody who has a 760. Now they're getting quite less than that. So that was going to be something I show. This is just a really helpful chart as well to be knowledgeable. The other thing that I was going to share with you guys is that if you want to stay updated on rates and in the market and have access to what I'm reading and my interpretation of how it's going to impact buyers and sellers this week, I have a weekly Monday text that I send out to all my clients and all my partners that are realtors. It
Mhm.
shows them where all the interest rates are for conventional, FHA, VA, USDA, and then jumbo. Jumbo is like, you're buying a $1.5 million property or $1.8 million property. And then I have three tiny paragraphs, and it's a 2 to 3 minute read. It lets you know what's going to happen this week and what happened last week, how this impacts specifically buyers, and how it impacts sellers and their confidence. So that's something I send out every Monday. If you guys want access to that, let me know. You have my phone number right here, and also in my name, it's at Laver Lens. So you can DM me on Instagram if you want that too. And then the last thing, Roxanne, is we have a interesting 2 loan programs coming out too at our company. We have a 0% down, no mortgage insurance option coming out. And
Mhm.
this is, I think it's going to be for conventional or maybe FHA. That's still in the works, but we're going to be coming out with that. So if you guys want to have that pricing for your open houses, I'm happy to provide that for you. And
Great.
then our last product is for reverse mortgages, but it's a reverse mortgage HELOC. So this is something that is coming out. So if somebody has a reverse mortgage and maybe they want to help their grandkids or kids buy a property, they can pull out money and not have a monthly mortgage payment. It just gets tied into their reverse mortgage as well.
Nice. Reverse mortgage HELOC. I like
Yeah, yeah,
that is fascinating. All right.
yeah. I
Good.
thought so too when I heard it. I was like, I haven't seen that one. So just stuff that we're doing that, banks don't have access to quite yet. And those are just 2 of the more unique ones that are new coming out right now that I wanted to share with you guys.
Thank you so much. And do I have this Instagram handle correct?
LENDS.
All right. So Instagram is at LA.
Yeah, I put it in the chat for you. Laver Lens. LAVERLENDS.
Lens.
Mm-hmm.
All right. This one is the correct one.
There we go. Thank you. Yeah, that's the best way to find me on there on Instagram too. Put out content. And yeah, if you guys have any questions on that, or if you want to get enrolled into the monthly text, those are something I send out personally. It's not an automated system that comes out. It's not corporate marketing. It's
Yeah.
me reading reports and taking the time to send that out for you guys. And I manually send them to you. So if you're getting them from me, it's very personal and it's very good information to have, and it'll keep you updated on rates at least once a week.
Excellent. All right. Very good. Well, thank you so much for this amazing information, Dan, for sharing all of your knowledge with us today. And audience, if you are thinking of working with Dan, Dan can be reached on his phone number or on his email address. And of course, as he mentioned, he is also on Instagram. So several ways of reaching out to him. And if you are thinking of selling or buying real estate in San Diego or anywhere in the US, you can reach out to me. There's my phone number or my email address. And I'm also on Instagram. And you can also find me on our website as well. So reach out to either one of us. And if you are watching this on YouTube, please give us a thumbs up and click on that subscribe button so that you can get our weekly videos coming through. And thank you for watching.
Yeah, thank you for having me, Roxanne.
Thank you, Dan.